Hello and welcome everyone. Thank you for joining us for today's webinar. My name is Stephanie Gizriel and I'm a director on the National Accounts team at Barron Capital. Today we will be discussing real estate with Jeff Kolitch, Portfolio Manager of the Barron Real Estate Fund and the Barron Real Estate Income Fund. We are proud to report that both of our real estate funds have maintained their highest 5-star rating from Morningstar. As of March 31st, 2023, Barron Real Estate Fund is the #1 ranked fund for each of the trailing 3, 5, and 10-year periods, and the #1 real estate fund since its inception 13 years ago. As of March 31st, 2023, the Barron Real Estate Income Fund is in the top 2 percentile of all real estate funds for the trailing 5-year performance period. Since its inception a little bit more than 5 years ago, its performance is almost 3 times greater than the REIT index. As always, I encourage you, those of you who have joined us, to submit questions either using your Q&A box on the Zoom screen or by emailing questions@barronfunds.com. We've received a few questions ahead of the call, which we will address. Hi, Jeff.
Hey, Steph, good to see you, and great to be here today, everyone. I've been looking forward to today's call. It certainly is timely as real estate has been front and center in the news, and our team's been very busy speaking to a meeting with management team. So a lot to discuss. Let's get started.
Great. All right, Jeff. So to kick us off, we're 4 months into 2023. Could you take a minute to share with us a few of the thoughts top of mind in regards to real estate?
Sure. Some of this we flushed out in our shareholder letters, which I encourage everyone to read. But I'll share a couple top of mind thoughts. Why don't I leave you with 3? Number 1, we wrote about this at the end of 2022, and we wrote about it again at the end of the first quarter. We remain optimistic about the prospects for public real estate in the real estate funds that we manage. And what we've been writing about is that we think this year, ultimately, notwithstanding expectations for ongoing volatility and our reasonable understanding of reasons to be cautious, we think that this year will ultimately set up to be a mirror image of 2022. And what we mean by that is that last year's headwinds will turn into tailwinds, and last year's tailwinds will turn into headwinds, and ultimately that will result in good returns. Meaning growth is likely to slow this year, which was a tailwind last year, but conversely, multi-decade high inflation and the most aggressive Fed tightening cycle ever on record and very high interest rates that kept going up, that's all starting to reverse course, which should be supportive of valuation multiples. The expansion in valuation multiples, we believe, will more than offset the slowdown in growth, ultimately resulting in pretty strong returns. That's comment 1. Comment number 2, there has been a narrative that has been circulating that there is a commercial real estate crisis on the horizon. Our team has a very strong view that those reports are sensationalized and misplaced. We do not believe that there is a commercial real estate crisis on the horizon. I'm happy to elaborate on that in the call during Q&A. Comment number 3 would be that we believe that most of the repricing of real estate in the public markets has already occurred. Said differently, we believe that public real estate stocks are on sale. Several are cheap. Very rarely do we identify opportunities to purchase what we deem are best-in-class, high-quality companies at discounted prices, and now is one of those times. Maybe we'll elaborate on some examples during Q&A. What else, Steph?
Great. Jeff, as you mentioned, we've received a number of questions on commercial real estate. Could you elaborate on why you do not believe a commercial real estate crisis is likely?
Sure. You know, the topic of a possible commercial real estate crisis, once again, I encourage people to review our shareholder letters, which are on our website, and perhaps our team can email it out to you as well. We spent a fair amount of time and a few pages really flushing out the details as it relates to thinking about commercial real estate, what could be on the horizon, et cetera. And we think we dispel the notion that there could be significant commercial real estate distress. The forecasts of widespread distress in commercial real estate. Once again, we think they're sensationalized. We think they're unlikely to materialize. And we think it's a very big mistake and a missed opportunity to paint the whole real estate industry with one brush that there's a big problem in the months ahead or the years ahead. So let's just step back for a minute and perhaps try to separate facts from fiction. So what would cause a commercial real estate crisis? Let's just tick through a few just in the next minute. Well, number one, we would think about, well, are commercial real estate business prospects rolling over? Are we going to see significant demand destruction? And headline number one, the prospects for most categories of real estate continue to be pretty good, and we're encouraged. That's comment one. Comment number two, the historical curse of real estate. If you study real estate over decades, the historical curse is when real estate becomes overbuilt and you're left with excess inventory heading into an economic downturn. New construction activity over the next few years is quite muted. There is very little new construction activity because it's not economical to do so given the rise in land costs, material costs, and labor costs. Curse number two, not a concern. Next one would be, is there excess leverage in the system? And many of the companies, the developers, the individuals, the institutions that focus on real estate certainly have learned their lessons. The scars perhaps are deep from the global financial crisis and other challenging periods. Headline, debt profiles are solid. Debt relative to cash flow, fixed versus floating, the debt maturity schedules over the next few years. Once again, we feel pretty good about the debt profiles in real estate. Again, another reason why we're not overly concerned. There's discussion about the banking system following Signature Valley Bank and Signature Bank and Credit Suisse, et cetera. And our sense and the work that we've done and the various folks that we've spoken to and management teams is that the banking system is in a position, a strong capital position. It's much more of a duration mismatch, if anything, more of an earnings issue for the banks rather than a solvency issue, given that they're appropriately capitalized. We'll see how this plays out over the months ahead, but that also is a convicted view. Comment number 5 on commercial real estate is, are we going to see a broad announcement over several months in the next few years of significant loan defaults? And once again, we think it's going to be mostly isolated to old office buildings, what we would deem B and C office buildings, where there will be a debt funding gap and insufficient new loan proceeds for refinancing purposes. But once again, most of real estate is appropriately capitalized. Values of the real estate have gone up. When refinancing occurs, it will be something that will be able to be addressed. And so stepping back, when we think demand, construction, balance sheets, banking systems, loan defaults, et cetera, it is a gross misrepresentation or hyperbole to suggest that a commercial real estate crisis is on the horizon. We're much more optimistic than what the press would lead you to believe. Hopefully that's sufficient. But again, I do encourage people, read our shareholder letter. We address this point right up front with much more detail than I just did, because we think it's top of mind for several clients.
That's great to hear. Thanks, Jeff. So we know that you and your team meet with management teams regularly. Could you share with us what you're hearing from management teams that you speak to recently?
So once again, thank you for the question, Steph. This is timely as well, because we're in the midst of first quarter earnings season, which has kicked off over the last couple of weeks, and this week will be busy once again. And so we're getting real-time updates from management teams. And we continue to meet with and travel to, visit with, and speak to management teams of companies that we currently have investments in and others that we're currently researching. And, you know, our team has put a program in place where we speak to management teams throughout the quarter. And we have terrific corporate relationships and access to management. And we think our real estate research, all of this is part of what we think contributes to our competitive edge, this access, the diligence we put in place, the number of times that we're speaking to management teams who want to speak to Barron Capital. And this gives us, we think, an edge vis-a-vis many of our peers. And so the question that I ask rhetorically is, what's the bottom line? What are we learning from the conversations that we're having with management teams? And the punchline is that, once again, real estate business trends and business prospects are pretty good for most categories of real estate, for most companies that we're evaluating. But let me peel it back because, as I said, we're getting real-time updates right now, and we just received updates across a broad swath of real estate. So let me just give you a few concrete examples. Number one, last week, we heard from the largest home builder in the entire country, D.R. Horton, okay? Headline, business is strong, outlook is encouraging. A few weeks prior to that, my colleague Dave Kirschenbaum and I traveled to Pennsylvania and met with Toll Brothers, the leading luxury home builder in this country, and we spent 4 to 5 hours with that management team. Headline, business activity is stabilized, business activity is good. A few weeks before that, I was in Florida meeting with the chairman of Lennar, Stuart Miller. Headline, again, this is the second largest home builder. Business activity is picked up, business activity is good. That's the residential side of the home building market. Two, one of my colleagues, George Tarras, a couple of weeks ago was down in DC meeting with several of the hotel companies and met with the CEO of Hilton, Chris Nassetta, the second largest hotel company in the world. Headline, no signs of a global slowdown in travel. We'll see how this unfolds over the next several months as well. Number three, last week we heard from the largest industrial REIT in the country, Prologis, which is a large position in both of our real estate funds. Headline, business is fabulous. Their rents, their in-place rents are more than 70% below market rent. So they have visibility into 70% growth over the next 4 to 5 years, something we're quite optimistic about. We have a long history of investing in real estate, casino, and gaming companies. We had the CEO of Caesars in our office 2 weeks ago, Tom Reeg, who was an excellent operator. Headline, business activity is good. Last week, we heard from Las Vegas Sands, also a top holding of ours. Business is rebounding much faster than what we expected, where they're focused in Singapore and Macau. Just on Friday, we spoke to one of the leading executives of a private data center company, which our firm has a long history in. Here's the headline that came from this executive. The demand in the next 10 years is going to be far superior than the demand in the prior 10 years because the need for compute power, think about autonomous vehicles, artificial intelligence, there is going to be a massive amount of data needed for storage. And so we're giving you these examples because this is what we do for work, which is peeling back real estate, not at a high level, but attacking each category of real estate, meeting with the management teams, getting on the road. And what we're hearing, what we're researching, what we're identifying is a very different narrative than what sells newspapers or some of the headlines were constructive. Let me stop there, see if there are any other comments or questions.
Thanks, Jeff. So in past calls and in your quarterly shareholder letters, you've discussed various investment themes and ideas. Could you take a minute to update our listeners on some current investment ideas?
Sure. Thank you, Steph. Again, we flushed this out in both of our letters. As we've talked about in the past, we're bottom-up investors, but then we also step back to try to see the forest through the trees, and we're a thematic investor as well. There are 4 themes that we're focused on, that we're bullish on as we look at over the next couple of years. We continue to be optimistic about the prospects for REITs, residential real estate, the housing market, number 2, travel-related real estate, and an other category, which consists of commercial real estate service firms and real estate alternative asset managers and property technology. All of these are convicted views where we think the prospects over the next 2 to 3 years are attractive. Just 20 seconds on each. We think the setup for REITs over the next 2 to 3 years is attractive. The stocks are down, valuations are reasonable, business fundamentals are generally solid, balance sheets are in good shape, dividend yields are well covered. There's some inflation protection for certain REITs, and we're focused on secular REITs where the cash flow should be more durable during an economic downturn. Think industrial REITs, think data centers, think towers, and we're also focused on short lease duration REITs that reprice on a more regular basis where the landlord has an ability to increase the rents to partially offset some of the expense headwinds. Think self-storage REITs, which reprice every 30 days, single-family rental REITs, which reprice once a year. There are a whole bunch of examples. I'm not going to go through it in REITs on the call, but we list in our letter several examples, just a few bullet points on the companies, the descriptions, and why we think they're attractively valued. That's comment one. Two, we're bullish on the housing market. For those that we've worked with over a long period of time, you know that this is a long-term view at Barron Capital. It boils down to our long-term optimism for the housing market is all about what's been a multi-decade structural underinvestment in housing. We continue to underbuild relative to the demographic needs. There's massive pent-up demand for shelter. But what's interesting on a near-term basis is the recovery in the housing market so far this year. Our research leads us to believe that there has been a meaningful uptick in demand, and buyers are adjusting and getting over the sticker shock of higher prices, higher mortgage rates. There's an element of fear of missing out on a home. People have been delaying for a long period of time. There's a lack of inventory, several years of pent-up demand. Perhaps people are adjusting by buying a smaller home or not exactly in the suburb where they may want to be. And I'd remind people on the call that in the most robust housing market ever on record, in 2005 and 6, guess where mortgage rates were? Exactly where they are today, around 6.5%. And so we're optimistic on housing. And there are, again, a bunch of companies that we're bullish on: Toll Brothers, Lennar, Lowe's, among others. Travel-related real estate, theme number 3. We've talked about this at Barron Capital. We focus on mega trends, and the mega trend that we think is going to persist in travel is the reprioritization or redirecting of discretionary dollars away from goods purchases and using some of that more towards experiences, namely travel. We're seeing it in several different age cohorts. And then when you layer on that the international traveler is coming back, the business traveler is coming back much faster than expected. Just as a sidebar, I've been traveling a lot the first 4 months of this year and been shocked how busy the airports are midweek with various travels at all hours of the day. So the demographic trends are good. The international travelers back, the group travelers back, the leisure travelers back. And oh, by the way, many of these stocks are on sale. MGM Resorts, Red Rock, among others. We have them all listed in our shareholder letter. Last theme would be this other bucket. We're long-term bullish on commercial real estate service firms. It's an oligopolistic industry that will be consolidated by the 2 leading players, that being CBRE Group and Jones Lang LaSalle. These stocks are silly cheap. They are trading at massive discounts to where they have over a long period of time. It is a gift to be able to step in and buy these stocks with a 2 to 3 year view. We're not suggesting they can't go a bit lower the months ahead. Maybe they won't act that well. But if you take a 2 to 3 year view, we see big upside, because what do you get? You get significant multiple expansion and growth over the next 3 years. We're also bullish, continue to be on the real estate alternative asset managers, where there's a market share gain opportunity as more and more assets are being allocated towards alternatives. And we're long-term bullish on Brookfield, which we've talked about and owned for over 13 years, and Blackstone as well. Let me stop there. I gave you a lot on themes.
Thanks, Jeff. You actually just hit on one of the names that we got a question from the audience on. Blackstone. It continues to be in the news. Could you maybe update us on your thoughts? Any reason for concerns there?
So Blackstone certainly has been in the news. Let me underscore the following point, which is we hold Blackstone in very high regard. We're a shareholder of the company. Blackstone is a world-class company. From our perspective, Blackstone checks the box for the definition of best in class. They have world-class talent. They have a leading brand. They have a strong investment track record. They have a strong and liquid balance sheet. They have loyal clients. It is an A+ company. That's comment number 1. Comment number 2, yes, as we know, Blackstone's received some unfavorable press the last few months for its non-traded REIT, where the view is that the valuations don't currently reflect market values because they're based on appraised values. We are in the camp that if you own certain public real estate stocks or certain public real estate mutual funds, that perhaps they may outperform non-traded REITs over the next couple of years because the public market has already repriced. We have a convicted view that our real estate strategies are going to do quite well over the next few years. What I do want to underscore for Blackstone is a few other recent points. Number one, and I don't know if everyone on the call is aware of this. Number one, they just announced, I think last week, if not the week before, they raised the largest ever private real estate fund, $30 billion from sophisticated capital, institutions, endowments, pension funds, and others. They want to lean into real estate right now. Why? Because there is a view that real estate is on sale. And we believe that Blackstone, with that $30 billion fund, when they put on leverage, it's really 80 to 100 billion of buying power, is likely going to be targeting public real estate, perhaps some companies that we own. Number two is Blackstone referenced this on their quarterly call last week. They're sitting on $200 billion of what's called dry powder, yet invested capital. Once again, a good chunk of that we think will be targeted for public real estate. Number three on Blackstone, the president of Blackstone, who we also hold in very high regard, John Gray, was interviewed on CNBC last week. I don't know if anyone saw him. And here was one of John's key messages. He said, and this is someone that's the largest Blackstone real estate investor in the world, the pretty good sense for what's happening globally, commercial, residential. And his message was, most of real estate is performing very well, other than old office building. And there is no commercial real estate crisis on the horizon. As you know, we concur with that view. He also said a few earnings calls prior to that quote, believe I'm getting this verbatim, that the best opportunities in real estate are in the public markets on the screen. And that's where they're spending a lot of their time. They could invest privately, they could invest publicly. They think the best opportunity is in the public market. So they've been in the press a lot. There are a few thoughts on Blackstone.
Great, thank you so much. So we're nearing the time we have for today's call. Maybe just a minute or two if you have any concluding thoughts that you'd like to share.
Good. With this call, if you haven't noticed, is a little shorter than the ones over the last year or two. We're endeavoring to make it a little shorter. And I see we've been on for about 20 minutes or so. You know, in terms of concluding thoughts, number one, I'm glad we had the opportunity to talk today. As I said, I do think it's very timely to consider and think about and research real estate. And from our perspective, it's absolutely the time to roll up one's sleeves and do homework, given the opportunity that we see in front of us. Our team remains very hard at work, and the conclusions that we're reaching are broadly encouraging. I'd end with the following. From our perspective, now is the time to lean into real estate, not shy away. You know, the time to shy away from real estate, that's a missed opportunity. That was, 18 months ago, after 3 straight years of very strong performance, peak valuations, early days of a Fed tightening cycle. Fast forward to today, most of public real estate has already repriced. We're getting to the end of a Fed tightening cycle, which often is a positive for real estate stocks. Many stocks are down. We're of the view, very different from many of the headlines out there, that now is absolutely the time to start to consider, research, and perhaps invest in real estate. That's comment number one. Comment number two, I've now been at Barron Capital. I'm in my 18th year, and some of the best purchases that our team has ever made has occurred when real estate is out of favor. I recall the period during the global financial crisis in 08 and 09, when there was a lot of carnage in real estate and many people wanted to stay away. And our team was doing our research, bringing management teams in and leaning into it. And we made fabulous investments during that time. That's exactly when you want to start to move in. In the early days of the pandemic, March and April of 2020, our team was screaming from the rooftops, now is the time after the sharp correction. And here we are once again in April 2023, and we think there's another gift that's being presented if one can have a 2 to 3 year view and think about the risk reward at this stage in the stocks, both for REITs and non-REITs. We talk about the upside downside ratio in our strategies. And when we look out over the next 2 to 3 years, we like this setup a lot. Once again, we talked about this in our shareholder letter. We believe over the next 2 to 3 years, we're going to generate very attractive returns. We detail all of our thoughts in our shareholder letters. Once again, I do encourage people to take a look at them, review them, and please don't ever hesitate to reach out to our team. our distribution team, staff, our broader distribution team, our real estate team. We'd be more than happy to follow up. We are responsive, and thank you for your time today.
Great. Thank you so much, Jeff. So with that, we'll conclude today's call. As Jeff mentioned, we tried to keep this short. So if you have additional questions, you can always email questions@barronfunds.com. You can find Jeff's quarterly letter on our website, www.barronfunds.com, as well as a replay of today's call. I want to thank Jeff for his comments and for all of you for joining us. Most importantly, we want to thank you for your continued support of the Barron Fund family. Goodbye.
Thank you.